short-term notes payable, and I'm going to be using as an example a note that has a principal or face value of $10,000, an annual interest rate of 12%, and it's a 4-month note. Most of your short-term notes payable are going to be due within a year, rather than longer than that. Okay, so how a company gets a notes payable, we would get some cash probably, and we would have a notes payable on our books for $10,000. Okay, that's not too bad so far. We have to compute the interest on the note. The first thing we do when we want to deal with any of our notes payable is compute the total interest on the note. And if you remember, that's going to be the principal times the rate times the time, which in this case would be the $10,000 face value times the 12% interest rate, and then times 4/12, because it is a 4-month note. So we're not going to pay a year's interest on it, only the 4 months. So our total interest is $400. Then the other term that you need are the proceeds. Actually, it's proceeds. It's a little, when you're doing an accounts receivable, it's the proceeds. The amount that you will repay, I'm just going to call it the amount repaid, the total amount repaid, is going to be the principal of $10,000, and it's going to be plus the interest. So the total amount repaid is going to be $10,400. So that gives you sort of an overall view of how the note is set up. The other thing, well, when the note is repaid, in other words, when we pay off the note, we would, at that time, we would go notes payable to get the note removed from our books for $10,000. Always on and off the books at the face value, but we would be paying out cash. We computed the amount repaid of $10,400, and the interest expense would be entered as the $400. Okay, so we computed the interest expense. We know how much that's going to be, and so this would be your general journal entry to record the repayment of the note. Now that assumes that it falls within one accounting period. What if it doesn't? What if, say the date of the note was 12/1, and so on 12/1 we get the cash and we have a note payable for $10,000. We know that we have to accrue interest over the life of the note, so when we get to the year end at 12/31, we're going to have to bring on that interest expense to deduct from that year's interest, that year's income statement, and so we're going to have interest expense and interest payable. And it's only going to be the amount of interest that we earned so far. So if we look at this, I picked 12% because it comes out, we're building up interest at a rate of $100 a month. So 12/31, we only have the month of December to bring on as interest expense, so that's $100. And so now we close the books. The interest expense is reported with our current income statement, books are closed, and then we're left with the interest payable, which comes forward on our balance sheet for the following year. So now, when it comes down to April 1st, when we pay off the note, because it's December, January, February, March, it's a 4-month note, we're going to pay off the notes payable. Okay, so the note is going to come off at its face value of $10,000. And we'll say, oh yeah, and now we'll reduce the interest payable, because we're going to pay that when we pay off the note. And that's the 100, but we're also going to book the interest expense for the current year, which would be the other 300, and then we write our check to pay off the note for the same $10,400. $1,400. Okay, so that's your basic way your short-term notes payable work.